that the prof asked me to cover. So 426, 1234, 1247, 1328, and 1627. Okay. Okay, so 426, Emily developed an innovative computer game called Home by Myself. It was so successful that she quickly followed up with 2 sequels. Home by Myself 2, Home by Myself 3. The cost of developing the games were $95,000 for HBM, $10,000 for HBM 2, and $15,000 for HBM 3. The production process consists of using her computer to copy the games to blank DVDs and then packing them with printed instructions in a display box. It takes longer to copy the original game than it takes to copy the sequels. Emily can produce, ship, in about 20 copies for HBM, 30 for 2, and 45 for 3. So what is the contribution margin per hour of Emily's time for each game? Okay. So when they ask for contribution margin, you're looking at variable costs, right? The fixed costs here are irrelevant, so you're looking at variable costs. So HBM1, you have a selling price of $49. And then you have variable costs of $1 and $4. The prorated development costs, they're considered fixed costs. They've just prorated it amongst the different DVDs. So you wouldn't include those. Okay, so if you add up the blank DVDs and the instruction and packaging, that's $5. And then with HBM1, they say you can do 20 copies in an hour. Multiply that by 20. 880 bucks. For number 2, it's the same thing. You got a selling price of 29. And variable cost of 250. And how many do they do an hour? 30. Is there any questions with what I'm doing? You guys good? Okay, $7.95. Okay, whenever that's for contribution margin, it's just revenue minus your variable cost. Unless there's something to do with capacity. Okay, and the third one, it's $29 again. And variable cost of $250 times 45. So like I said, the development costs are fixed and they're sunk. It's already been spent. So whether you go on producing more or not, they've already been spent. So it's irrelevant. So as you can see here, the contribution margin is the highest on the third one, and then the first one, and then the second one. So what is the next question asked? In what order should Emily produce the games? So obviously if you're making the most, if number 3 is contributing the most to profitability, you'll produce number 3 first, and then HBM1, and then HBM2. HBM 3, 1, Okay, using the general decision rule for constrained capacity, what is the most Emily should be willing to pay per hour for a worker to duplicate and pack DVDs after her normal working hours? Assume that the worker would work the same pace as Emily. Okay, so we said that we'd want to produce 3 first. So if the demand for 3 is, let's see, where's the demand? The daily demand for HBM3 is 90 games. So if it's 90 games per day and we can do 45 in an hour, we might as well meet that demand first, right? You can sell the 90 games, 90 HBM3, and that would take 2 hours, right? Then the next profitable DVD would be number 1. So number 1 has a daily demand of 120. So if you do 120, and how many do they produce in an hour? 20. So obviously it takes 6 hours, right? So do 120 HBM1, you get 6 hours. So in this case, Emily's already worked as much as she can, right? Her work day is 8 hours. So she doesn't have time to produce HBM2. So the question is asking using what is the most Emily should be willing to pay for a worker to duplicate. So the most she'd be willing to pay, so obviously she can do this herself, right? But the most she'd be willing to pay someone would be, what is it? So it's, what's the demand for HBM1? So HBM2 is 120 games as well, right? And they do 30 an hour. So that takes 4 hours, right? So 4 hours multiplied by your 795. $3,180. So at the very least, she'd be willing to pay $3,180. Because at least if she paid anything more than that, there's really no point in doing that, right? Because this is how much it produces. It would be a loss. So at the very most, she'd be willing to pay someone to do $3,180 for 4 hours. Now, probably 4 hours is part-time work. If nobody's available, then you'd pay someone the $3,180 for the 8 hours, and they could do something else in the other 4 hours. Any questions? Good? All right.
So pay per hour should divide by 4 hours.
The pay per hour?
Yeah, because the question is willing to pay per hour.
Right, so it's per hour it's $7.95. Yeah. But this is total, right? 3,180 is total. Okay? Okay, what's the next one? 1234. Okay. All right. Okay, MPV and payback. Okay. Equipment with a cost of $60,000 will, if required, generate annual savings of $30,000 for 6 years, at which time it will have no further use or value. The firm has a marginal tax rate of 40%, requires 10% return, and uses straight line amortization, ignoring inflation. What is the after-tax cash flow for each year? So when you look at these types of questions, the first thing you should think about, they give you a bunch of numbers, and you should always think that these numbers are pre-tax, right? And you want to convert them to after-tax dollars. So when we look, so what is the initial investment? The initial investment, anyone know? Yeah, 60,000, right? So that's, and that's year 0. So now we're trying to figure out the cash flows for the remaining 6 years. So years 1 to 6. Let's see here. So it says that it'll generate annual savings of 30,000 a year, right? So here's our savings. Of 30K. So 30K is pre-tax, right? And they said that there's a tax rate of 40%. So if you do after tax, multiply that. 0.1 minus 0.4. Okay? Yeah. That's as big as I'm going to write. You can't read it? I'll try. Let me see. I'll try. Good? All right. Okay, so 18K for the savings, and then there's the amortization. So there's straight line amortization. Okay, so the cost of the equipment is 60,000, and it's good for 6 years, right? 60 divided by 6, that's 10K. 10K per year, right? So the tax effect, if you tax effect that, multiply that by 40%, right? 40%. That's 4K, right? So you got savings of 18K and savings of 4K after tax. So you add that up. So 4 and 18. 22, okay? And that 22K is from years 1 to 6. So next, what is the MPV of this investment? So now you have to, what do you call it? PV that, all those cash flows back, right? Are you guys going to have a calculator? Yeah.
Why did you multiply for the amortization? Use 40% loss for the savings into 60%.
Yeah, because the thing is, amortization is tax deductible, right? So that's why so on a tax return, you'd have your revenues minus your expenses, but the expenses would be 40% of the expenses what you're getting back. That's why you multiply by 40 as opposed to the revenue after tax, okay? All right, where was I? I lost my train of thought. Yeah, are you guys going to have a financial calculator? Are you guys allowed that? Oh, no? Oh, okay. Yeah, I'm not used to using that. Okay. So when you're going to, you're going to present value all this, right? So the MPV would be, so you have your time, year 0, right? Minus 60,000. And then you add back your 22,000 times the annuity factor. I don't know what that is. Oh, I have it here. It's 4. So it's 10% at 6 years. So I think it's 4. According to here, it's 4.3553. 3553. That's your PVFA. 6 years. I know this is small. 6 years and 10%. Okay, but you should know that. I'm telling you right now, so just write it down as I'm talking. Okay? So look up on your table 6 years and 10%, and you're good. And then you should get 35 817. You guys understand how to do that? Yeah, I think it's pretty straightforward. Yeah. Okay, C. What is the payback period? So there's two, I don't know if we talked about this, two ways of doing it. There's discounted payback and payback. I don't know if you guys heard of that, both of those terms. I'm pretty sure this question is referring back to undiscounted payback. So undiscounted payback is you're taking your cumulative cash flows. So you have 22 each year. So you paid 60,000 for this project, or what is it, a machine? Yeah, this equipment. Because you know the cash flows are consistent every year, you can just divide it by 22,000. Right? Because it's just a simple, how many years will it take to pay this 60,000 off? So it's like, obviously it's under 3 years, right? Because it's if it was 3 years, it'd be 66K. So if you do that, it's 2.73. The other way of doing it, let's just say the cash flows weren't equal. You could take, so you know that's at least 2 years, right? Because the 22 goes into evenly 40, like it'll be 44, right? And then you wouldn't have enough to cover the 60. So you'd have the 2 years plus the 60 minus 44 divided by 60. No, divided by 22. Okay? So that's 16 divided by the 22, and that would give you the 0.73. Any questions? No? Okay. 12, 4, 7. Oh, this one's long. Sorry? Yeah, how do I do that? Sorry, where is it? Okay, so the Hotshots are a professional hockey team with a long tradition of winning. However, over the past 3 years, the team has not won a major championship and attendance at games have dropped considerably. A large hockey manufacturer is the team's major corporate sponsor. Carl Cliff, president of the hockey company, is also the president of the Hotshots. Cliff proposes that the team purchase the services of star player Bob Jackson. Jackson would create great excitement for Hotshots fans and sponsors. Jackson's agents notify Cliff that terms for the superstar signing with the Hotshots are a signing bonus of $8 million and a house in Toronto at 5. The annual salary and cost of living adjustments are under negotiation. Cliff's initial reaction is one of shock. However, he decides to examine the cash inflows expected if Jackson is signed for a 4-year contract. Net gate receipts would most likely increase by $2 million a year. Corporate sponsorships would increase by $2.5 million. Royalties, $500,000 a year. And merchandise income would increase by $1 million. Cliff believes that 12% discount rate is appropriate for this investment. The Hotshots marginal tax rate is 20%. The signing bonus can be amortized and has an annual tax deduction of $2 million. Okay, so it says create a timeline that shows the relevant cash flows for this problem. So we have our initial investment, right? The initial investment is your signing bonus of 8 million, and then the house, right? So that's 8 mil plus the 5. Okay? So then if they get this guy on the hockey team, they're able to get a bunch of revenues, increase in revenues. So these increase in revenues are supposed to occur from years 1 to 4. So if you go 1 to 4, we have incremental revenue increases. So what do we have? The first one, what's the first one? It's all over here. Net gate receipts, right? The first one is net gate receipts of $2 million a year. So that's the first 2. What's the next one? Yeah, the sponsorships at 2.5. Next. Royalties, right? $500,000. Next. Yeah, merchandise of $1 million. Okay? So that's, what is that? 4.5, 5, 6. Okay? $6 million. But then we also have to pay this guy's salary, right? We don't know that number. So we'll just make it an S for now. The problem hasn't given us that number. Now, these are pre-tax numbers, right? So we have to after-tax it, right? So this is how you'd go about it. You can either go, so the tax is, the first component would be the 6 million times, what's the tax rate? 20%. 6 times the 20%, that's 1.2, right? But there's also the signing bonus. Excuse me. The signing bonus, what did they say the signing bonus was? 8, right? $8 million. So the signing bonus, because he got a lump sum, we can amortize that over 4 years. That's why at the end they told us there's a tax deduction of $2 million. So there's $2 million per year for 4 years. So the $2 million you'll get a tax deduction for that. So the 2 would be times that by 20%. How much is that? That's 400,000. 0.4. Okay? The thing is, this is a payment, and that's positive, right? You're going to pay taxes on this. You're going to get a tax credit for this, right? So the net of these two should be 800K. Okay? Does everyone get what I just did? Yeah? Okay. So if you add that all up, oh, sorry, minus. It's minus, right? So if you add that up, you get an equation. 6 million minus the 0.8, 5.2. Oh, right. The salary. The salary is going to get taxed as well, right? 20%. So it's only 80% of the salary. Right? If you were to get a salary, it'd have to be taxed. So that's why I put 80%. Okay? Minus 0.8 of the salary. Okay, B. Assuming that he's not willing to lose money on the contract, so the first question was just asking us to outline all the relevant cash flows. That's it. We weren't trying to solve anything. Assuming that he is not willing to lose money on the contract, what is the maximum amount per year that Cliff would be willing to pay Jackson? It says you need to set up a spreadsheet. Yeah, so we're going to use the algebraic approach, which is why we have the S there. So he's not willing to lose money on the contract. What is the maximum amount? So what is the maximum amount he'd want to pay Cliff? You want to make sure that the NPV is 0, right? If the NPV is negative, you're losing money and you don't want to hire this guy. So at the basic minimum, the maximum money that he pays this superstar would make NPV 0. Because then at least it'll be, you won't lose any money. So that would be the max amount. So let's figure out how much that is. Okay. So I said set NPV to 0. So 0. And then we have, what is our first cash flow? The minus 13, right? The minus 13, and then, so that would be year 0. Now we have our cash flows from years 1 to 4. So that would be this equation here, right? 5.2 minus 0.8s, because we don't know the salary yet. But what else am I missing? You need to present value this, right? Because this is every year for 4 years. So you'll have to use how are we going to get the present value, the factor? What numbers? Can someone tell me? So it's 4 years. So you know you're going to have a factor for 4 years. What's the discount rate are we supposed to use? The 12%, right? So 4 years, 12%, and it's annuity, right? And that number is, what's that number? I have here 3.37. Is that right? Yeah. Okay. Yeah, so you're going to multiply that. Now you just work it out, right? Simple algebra. If you do it correctly, it's 1.149325. Okay? Multiplied. Okay? Work this inside, and then add them all up. And if you do it right, it should be just over 1.1 million. So what does this tell us, this 1.1 million? At a maximum, they're willing to pay him a salary of 1.1 million. And at that salary level would make the NPV 0. Anything more than that is not worth to take him on. And C, identify possible additional factors that Cliff should consider when deciding whether to sign Jackson. So obviously, the thing is, we're hiring him based on his past performance, but his past performance is not an indicator of his future results, right? He may not be the star that he was, right? So that's one factor. Another thing is there's obviously other sports in the city. So we don't know are they playing at the same time, these other sports, right? We know we live in Toronto. We have how many sports teams? We do get times when 2 teams play on the same day. That also affect your revenues, right? Because they have pretty big revenue increases that they're projecting because of this guy. And then also, is this guy going to really produce a winning season? Because they did say that the team had not won a championship for a while. So is he going to produce a championship or a winning season? If he doesn't, how is that going to affect your gate receipts, right? Because we did have projections of increases in gate receipts. Okay, and then D. So this is like your qualitative stuff, right? You write something. If you write something, you get the mark. Make sure it makes sense, though. D. For each of the relevant cash flows in the problem. Discuss why Cliff cannot be certain about the dollar amount of the cash flow. So there's two things that are certain in here. What are the two things that are certain in terms of dollars? He's getting a house, and he's getting paid, and he's getting a signing bonus. That's already been set out in the contract. Those two things are the certain things. So this is a win. This is a good situation for him, right? He's guaranteed his house and his salary, his signing bonus. But for the company, for the hockey team, they've projected all these things here, these revenues, but we don't have no idea whether it's going to actually happen, right? All these numbers that we just computed, the increase in gate receipts, the corporate sponsorships, the royalties, they're all dependent on this guy, whether he performs and the economy is good, right? Like people want to go to the games, is the team winning, all these uncertain things. So there's so many different factors, right? He just wants you to list out a couple. What if he gets injured? The player gets injured. You know what I mean? We've seen that before too, right? Who just got injured? You guys watch basketball? What's his name? Russell Westbrook. He got injured. I'm sure that affected the Oklahoma City's sales and performance. Okay, so yeah, that's just got to take those things into account. But yeah, that's the piece that's uncertain. What we're spending to start this thing is certain, but all the revenue projections are not. Any questions? Yeah? The point, okay, so we don't know how much he's going to get paid. We know that he has a signing bonus, but he's obviously going to have a salary, but they haven't given us the salary number. So why it's 0.8 is because there's a tax rate, right? The 20% tax rate. So that's the after-tax rate, right? Because we want to be consistent. Sorry? Yeah. Okay. So we want to be consistent, right? We did our cash flows after tax, the 6 million minus 1.2, and then we also took into account the signing bonus, had a tax positive tax inflow of 400,000. Okay, what is the next one I'm supposed to do? Any more questions? No. Okay, 1328. I'm going to erase this, okay? Oh, I don't have any information about your actual exam. Email the prof. He hasn't told me anything. He just gave me these questions and I'm kind of going through them with you guys. No, I'm just going through the ones here, these questions. Okay? Okay, so 1328. Transfer pricing. Wood Inc. manufactures wood poles. It has two divisions, harvesting and sawing, which are both evaluated as profit centers. So that's a key thing you should note down, that they're evaluated as profit centers. The harvesting division is responsible for all the harvesting operations and transfers logs to the sawing division, which transforms the logs into poles for external customers. Sawing can produce 10,000 poles per year. The sawing division is currently producing at full capacity, after management decided a year ago to manufacture high-demand wood pole S, that can be sold readily. The manager of the sawing division suggests that the maximum price the division can pay for logs transferred from harvesting is $61.50 per log. The following information supports this suggestion. The manager of the harvesting division disagrees with the proposal transfer price. The division is operating at full capacity and can sell all the logs it produces to external customers for 75. Moreover, the director says, for each unit of pole S, my direct labor cost is 40.50, variable at 9.50, and fixed at 15. I cannot spend 65 to cut trees and sell them for 61.50. Okay, so determine whether it would be beneficial for the company as a whole if logs are determine whether it would be beneficial for the company as a whole if logs were transferred to the sawing division at the suggested price of 61.50. All right. So whenever you look at these types of questions, you want to always calculate the contribution margin. Okay? So which one is this? Okay, the harvest division, they can sell it outside, right, for $75. So let's see what their contribution margin is if they do sell it at 75. So their selling price is 75. So what I say contribution margin, right? You're going to take into account variable costs, right? So what are their variable costs for the harvest division? Anyone know? Let's see. So he says here, what is it? Where is it? For each unit of pole S, my direct labor cost is 40.50. Yeah, my direct labor cost is 40.50, and variable overhead is 9.50. So there's your variable cost minus how much? Is it? 40.50. Minus 9.50, right? So how much is that? 49.50, that's 25. So that's 25 bucks a log, right? How much logs what's their capacity? Sawing, no, not sawing. Yeah. 10,000, right? 10,000 poles per year. So that's $250,000. Okay? So now let's figure out, we need to figure out how much because there's two divisions, but we want to make the best decision for the whole company as a whole as opposed to each division. So let's do the contribution margin for pole S, which is what the sawing division is selling. So sawing. So what's the selling price of pole S? Sorry? Yeah, 122. And what are the costs? There's two sets of costs, right? You got to take into account, first of all, harvest costs, right? Those variable costs. Right, because remember, they're transferring the log to sawing, but then sawing is doing other things to it to make it pole S. Okay? Understand the process. When these questions, you have to really read the question, understand what's happening. So 40.50 minus 9.50. So that's the first set from harvest group. So what's sawing, the saw division's cost? So we have direct labor at $35, right? We got variable overhead of $450. Is there anything else? Do we put in the fixed overhead? No, right? We'll put in the direct materials though, of $250. So that could be, it says other than logs, so whatever else they use to produce this pole S. So how much is that? That's 50. That's 6, right? 6 6, 7, 42 and 50, 92, 8, 30, right? And 10,000, right? 10,000. Okay, so is it better? Which is better, right? It's better to produce this pole S because it has a higher contribution margin of 300,000. Okay, so next question. Explain the impact of transferring the logs to the sawing division at 6150 on the performance of each division and specifically on each manager. So the problem with this is when you're transferring at 6150, remember in the beginning of the question it said that both divisions are profit centers. So both divisions are profit maximizing. So if you transfer at 6150, what's happening is that you're just transferring the profit from one division to the other. Right? Because the thing is, there's a cost of what? They're overcharging the harvest division. If they transfer, because technically they could just transfer at 50, right? That's their variable cost. But they're transferring at 6150. So they're overcharging than what they need to. But then again, they could sell it for 75, right? They could make a higher profit if they just sold the logs outside, right? Remember the question says 75? So the profit would be technically even higher if they sold at 75. So the profit, so you know what I mean? So the profit is just being transferred to the what division is it? To the saw division. Because they're able to sell it, they're reaping all the benefit, right? Because they're going to do some stuff to it, whatever they do to it, and sell it for 122, and they're getting all that value. And the harvest division will not look, they won't look competitive. And then, you know, they may look to shut it down, right? Because they're both profit centers. And harvest is not maximizing its profits because technically they could sell it for 75, but they're not. You understand? Okay, so, I don't know. I explained it, I'm not going to write it down, but yeah. So they're simply just moving profits from one division to the other. So the last question is, determine the minimum and the maximum transfer price that could be used to account for the transfer of logs from harvest to sawing. Recommend an appropriate transfer price. Justify your recommendation. So what is the minimum transfer price? At a minimum, because there's no right answer to this. What do you think is the minimum transfer price? What must, sorry, go ahead. Oh, so what must, at a minimum, harvest division needs to cover its variable costs, right? So at a minimum, they should charge what? How much? Yeah, 50. At a basic minimum, they should charge 50. Although we know that they have fixed costs, it's not relevant, right? We just need, at a minimum, they need to charge $50. So the minimum is $50 because that's our variable cost for harvest. Now, what's the maximum transfer price? How much? How much? Yeah, 75, right? Why? Because that's how much they can sell it for, right? There's buyers out there that will buy it at 75, and they have limited capacity, right? There's only 10,000 logs that they produce, so this is viable, right? It's not like they can produce more. Right, so this is the range that you'd want it in between. So something in between there should be fair. So the 6150 seems fair, and we've seen that because the contribution margin is higher than in this scenario. Is there any questions? Okay. What's the next one? Oh, you know what? I should have said something. Oh, sorry. I made a mistake. They're at capacity, right? So they technically should be charging 75. There's no idle capacity. So say for instance, because everything could go to this other company for 75, so they should be charging 75. Because if they had, let's just say they were producing 15,000 and outside market wanted the 10, then the 5 could go at 6150. Do you guys understand what I'm saying? Because there's idle capacity, then you could sell it for less because it's also just going to sit there, right? So you might as well get something for it. But because it's the division's operating at full capacity, you should be selling it at 75 because it doesn't make sense because the sawing division, they need this product, right? So if harvest is not there, then they have to go buy it out in the market for 75 anyway, right? So it should be 75, the market, because it's full capacity. But another situation could be if there was idle capacity, then 6150 is appropriate because it's not being sold anywhere else. It will just sit there, and you'd want to maximize your revenues, your profits, because each are evaluated on that. Okay. Okay. What's the next one? Next one. Okay, 1627. I think this one's really easy. 16. Just get to that thing. You haven't learned chapter 16?
No.
You don't have any more classes?
It's on Monday or tomorrow.
Yeah, okay. Well, it's on the exam anyway, so yeah. It must be on the exam. You wouldn't have told me to cover it. So you guys still have classes? I thought your exam is next week, no? Oh, okay. 1627, yeah. Anyway, this is like really easy. It's just formulas. Okay, so there's a table with data: income, investment, sales, ROI, ROS, and investment turnover. Some of them are blank, some of them are given. So they want you to figure out the blanks. Know a couple things. Since you guys didn't do the chapter, I'll just give you a couple of formulas. So return on investment is what? It's income divided by investment, right? That's your return on investment. Return on sales. Where's my... Okay? And then, so as I'm writing this, why don't you guys attempt it? Well, so that you kind of know what you're doing. It's really easy, I'm giving the formula, so you're just like plopping the numbers in. Return on investment. Okay, so return on investment can also be done like this. Investment, TO means turnover, times return on sales. Okay? Let me see, is that else? Anything else you need? No. Okay. So why don't you do the first one? The first one, A. So unit 1 has your income, it's giving you ROI, giving you investment turnover. And it wants you to figure out the actual investment. So how would you go about doing that? Yeah, sorry, divided by? Remember, you're rearranging the formula, right? Yeah, you're dividing it. That's right. Okay? So what is it? How much is it?
15K.
Yeah. So $50K, right? The 10,000 is what? What's the 10,000? Your income, right? And the 20% is your return on investment. So income divided by return on investment would give you your investment. You just rearrange that formula. How about B? I don't know if you can do B right away. Yeah, sorry, say that again. I can't hear you.
For C, use the return on investment outside of use return on
Okay, hold on. For C, you use your return on investment? Divided by investment turnover, right? So for C, so how much is that?
0.066.
Yeah. So that's 20% divided by 3, 6.67%. Whenever you do these things, you should always put into percentage. Okay? So 6.67%. So now that you have C, I think you can do B. So what's B? So B is the sales number, right? So that would be B. So sales equals what? You have your income. Yeah. 10,000 divided by what? Yeah. Yeah, C. So how much is that? So 10,000 divided by 6 2/3%. It's a big number. Yeah. 150K. Okay, D. So D is return on sales. No, sorry. D is income. So how can you figure out D? So D you can get, you got your return on sales, right? Divided by what? Or multiplied? Yeah, the sales number, right? So 10% times what? 500K? 50K. Oh, you have to do F first. What's F? Skip E. You gotta do F first. F is return on, they're asking for return on investment. %? Yeah, 20%. How'd you get that? Yeah, use this formula. Okay? 2 times 10%. What's E? You're looking for the investment. Yeah, use this one, eh? Yeah, 250. So what did you do? You took your income of what? 50K divided by? Yeah. Okay, E, F, G. How many left? Oh, still some left. Okay, G. G's for asking for income. So you're gonna use this one. Yeah, 75. So what did you do? You took 25% ROI times what? 300K. H is asking for the sales. Yeah, so 75,000. So 75,000 is your income divided by ROS, which is 15%. Last one. Yeah. So 25% divided by 15%, which is your investment turnover. So 1.6 times. I don't know if he does that, but I just put an X for times. You could put times too if you want. Okay? You know what? We got some time. I can do this other one. 16.35. Take a look at it and see. Should be pretty straightforward. Okay. So EVA means economic value added. Okay, backcountry hiking company produces and sells specialty camping equipment nationally, internationally. Following is information about 2 divisions after exchange rate corrections. Okay, so calculate each division's return on investment. So what did we say? Return on investment is what? Our operating income divided by the investment, right? In other words, it's also like your average operating assets. The investment is like is your total assets, averaged over year. So what is the return on investment for Germany? ROIG. Yeah, how did you get that? You took the operating income of 100 divided by invested capital, which is your investment, 400K. So 25%. What about the other country, Canada? Same thing, right? 750 divided by 2,000. How much is that? Yeah, 37.5%. Yeah. Okay. B. Calculate each division's residual income. So, residual income is you take your operating income, you take your assets multiplied by the required rate of return, and you net that against your operating income. I know you guys didn't learn it, so I'm telling you right now. Okay? I'll write it down. It's residual income is you're just taking out your required rate of return. So you take your operating income, and then how much did you require to return on this like what's your rate of return? take minus that, and that's your residual. So did they give you a required rate of return? Yeah, they did, 10%. So how would you go about, OI means operating income, okay? RR is required return times assets. Okay? So for Germany, what's the operating income? It's 100,000, right? And the required return is 10%. What is the assets of Germany? 400,000, right? So if you take, so basically they've required 10%, a required rate of return of 40,000, right? They have assets of 400. To multiply that 10% is 40,000 in return. So the residual income is the 100 minus the 40, which is 60. Okay? Residual G, 100 minus 400 times 10%, which is 60. Okay? So do Canada. Operating income of 750. Assets of 2 million. How much is this? $550, right? It's just another way of evaluating performance. So if you have a positive residual, that means you've done very well. If you have a negative residual, it means you didn't perform up to expectations. Okay. And then calculate each division's EVA. So EVA is economic value added. And basically what you're doing here is, I'll write it down. After tax OI minus. Have you guys heard of the term WACC? WACC? Weighted average cost of capital? No? Okay, discount rate. Same thing. Discount rate, WACC. Okay? What year is it? This is a second year? First year? Second year? Okay, second year. All right. WACC times net assets. So net assets is assets minus liabilities. Okay? It's just assets minus liabilities. So, okay, so here they're giving you the weighted average cost of capital. You never heard of WACC. You guys never took finance? Oh, okay. All right. Okay, so the EVA for Germany. So they gave you the after-tax income, right? 60K. WACC. What's the WACC? 9%, right? Times your net assets. Yeah, 392. So 400 minus 8. Okay? So just see how much is that? Well, it says here 24,750. Hopefully you guys got that too. Yeah? Okay. And then for Canada, after-tax income of 300, and then WACC is the same. Net assets, oh no, sorry. Okay. Okay, D, evaluate the two divisions. Write a memo to the CEO explaining the performance of the two divisions. So we can evaluate them on return on investment. If we evaluate them based on that, who's performing better? So Canada is, right? It has a higher return on investment. Suppose the German division had an opportunity to invest $350,000 in a project that would generate sales of $500,000 and a return on sales of 10% or $50,000. Would the division manager be likely to undertake this project if he or she is evaluated using ROI? Let's see. So what's the new ROI on this? We have to figure out that, right? So what do we say ROI is? Income over the investment, right? So what income, how much are they getting? We generate sales of 500 and return on sales of 10%. So we will need to figure out the income use. We can get that though, right? Because we have return on sales of 10% and we have the sales figure. So we just fill in the blank. So how much is the income? I don't have my calculator. 10% and 500,000. So it's 50,000, right? The income is 50,000. And then what was the previous income? Hold on. Because this is Germany. What was the previous income before this project? 100, right? So there's our income. Right? New income, if you were to take on this new venture, divided by our investment. So 400 plus, what's the other number? 400 is our initial investment. What are we investing further? Yeah, 350. How much is that? $150 over $750. You're good, eh? You're good. You always do it in your head. 20%. Yeah. 20%. Yeah, so 20%. So is it better or not? No, it's not better, right? Because if they're evaluated on return on investment and they take on this new project, they're making less, right? So they wouldn't take it because they're originally making 25%. We're talking about Germany here. So they wouldn't take it, okay? And then recommend a performance evaluation measure that would increase the manager's incentives to make decisions that would be in the best interest of the owners. So what's wrong with this? Just evaluating on ROI. Because this is still making money, right? It's just dragging, it's not making as much, but it's still making money, and that's why it's dragging it down, right? So probably a better measure would be EVA, economic value added, which is, because we're taking into account our cost of capital. So cost of capital is like how much it costs for us to borrow money to get funds. Because companies have money and they can put it here or there. So they have to decide where to put it and how much it would cost them to get more money if they want to invest it somewhere else. So to take that into account and the taxes is more value add. Okay? All right, is there any questions? Okay, that's all I got. Thanks, guys.